Listen to me. If you are retired or within 10 years of calling it quits, you have worked way too hard for your nest egg to lose sleep over market swings. I get it. You open your monthly statements, you see inflation eating away at your purchasing power, and suddenly every commercial on television or radio is screaming at you to buy physical gold. They paint a terrifying picture, don't they? They tell you the dollar is going to collapse, the stock market is a house of cards, and moving your entire 401k or traditional IRA into a Gold IRA is the only safe haven left. But before you make a move that could cost you tens of thousands of dollars in hidden fees and tax penalties, I need you to stand in your truth, take a deep breath, and learn the facts about how a Gold IRA actually works. First, what is a Gold IRA? It is a specialized, self-directed individual retirement account that holds physical gold coins or bars instead of standard assets like stocks, bonds, or index funds. That sounds comforting on the surface because gold is tangible. You can feel its weight, right? But here is the very first lesson you must understand: you cannot store this gold in a safe in your home or in a personal deposit box. IRS rules are crystal clear on this point. If you take physical possession of that IRA gold yourself, the IRS considers it an immediate taxable distribution. That means you could owe regular income taxes on your entire balance plus potential early withdrawal penalties if you are under age 59 and a half. Your gold must be held in a high-security, IRS-approved depository managed by an authorized custodian. Now let us tackle the biggest question everyone forgets to ask until it is too late: what does this actually cost you? In a standard retirement account holding low-cost index funds, your fees are practically zero. A Gold IRA is a completely different financial animal. First, you pay a one-time account setup fee. Then you pay an annual administration fee to the custodian. On top of that, you pay an annual storage and insurance fee to the depository where your metal lives. And we are not done yet. When you buy the gold, dealers charge a premium above the spot market price of gold, and when you want to sell it back later, they buy it below the spot price. That difference is called the spread. If you set up a Gold IRA with a modest amount, say $25,000, those fixed annual fees can easily devour 2 to 3% of your account balance every single year. That quiet erosion drains your hard-earned wealth regardless of what gold prices are doing. Here is another critical financial reality: gold does not produce income. It does not pay you a quarterly dividend, and it does not pay you monthly interest. A share of stock represents an ownership stake in a company that creates products and generates earnings. A bond pays you guaranteed yield. Gold just sits in a vault. It only grows in value if someone else is willing to pay a higher spot price for it in the future. When you are in retirement or approaching it, cash flow and income are your best friends because you need reliable money to cover your everyday living expenses and medical bills. What happens when you reach required minimum distribution age? That is another huge trap. Under federal law, once you reach your required minimum distribution age, you must start taking withdrawals from your traditional retirement accounts. With a traditional stock or bond account, selling a few shares to take cash is simple. But with a Gold IRA, taking your required distribution means you either have to liquidate physical coins at dealer prices or have actual physical metal shipped to your door as a taxable distribution in kind, which creates complex tax calculations and shipping fees. So how do you protect yourself without letting fear run the show? The foundation of financial freedom is proper diversification. Never panic. Gold should never be an all-or-nothing rescue plan for your retirement. If you genuinely want gold in your financial plan to hedge against inflation, limit your allocation to no more than 5 to 10% of your total liquid net worth. Anything more than that exposes your retirement security to unnecessary risk. If you choose to move forward, follow these non-negotiable action steps. First, always execute a direct trustee-to-trustee transfer where your money moves directly from your old custodian to your new custodian. Never perform an indirect 60-day rollover where a check is made out to you personally. If you miss that strict 60-day window by even one single day, the entire sum becomes taxable income. Second, demand a complete, line-item written fee schedule before signing a single paper. Third, verify that the custodian and depository are fully IRS approved. And finally, talk to an independent, fee-only financial planner who acts as a fiduciary and does not earn a commission from selling you precious metals. Stand up for your financial future, ask the tough questions, and never let fear make decisions for your money.